We're going to walk through what is the average price per unit in your area. What is the cap rate? How much sales volume sold over the course of 2021? What are the rental rates of a studio, 1 bedroom, 2 bedroom, 3 bedroom? And then of course, we're going to talk about what can we expect to see throughout this year in terms of where will values end up. And I think you're going to be very excited about what the findings tell us. Hi, this is Chris German. Welcome back to the Apartment Dealer Show. Today we're going to walk through our 2021 end of year market update so that you know the real numbers as we head into 2022 here in terms of where our current property values, where our current rental rates, and we will end with talking about where do we see values and rental rates and vacancy, what's the trajectory as we head through 2022. Now, the data that we're going to be relying on is compiled by CoStar Group. CoStar is the most well-known analytics company that simply does that. They compile all the market analytics and they sell it to brokers like myself. That's important because they do not have a dog in the race. They do not care whether you want to buy or sell. They don't care if the market's up or down. They simply just state the facts. And that's different than other market updates you might find that are compiled by a brokerage firm. Why? Because, and maybe not purposely so, but it's when you depend on sales, that might skew your judgment in terms of the data that you're utilizing, the data that you're sharing with your clients. So we like to use a third party source. Of course, I have the practical day-to-day experience of being involved and representing our clients in multifamily purchases and sales. And so I have a real sense of how many days it's taking for properties to sell. Being a landlord myself, I have a real sense of how long can a vacancy be filled, what are the various rental rates in different areas. So I have that practical knowledge, but the facts and figures we're going to be utilizing today are compiled by CoStar Group when it comes to the property values, cap rates, and so forth. Then when we move over to rental rates in your area, we'll be utilizing Zillow, Rentometer, and CoStar Group for the data that we put together there. So let's go ahead and dig in. If you watched the 3 first videos that I recorded at the beginning of this year, you know that there's 3 things that we learned. Property values, multifamily property values are stable. Rental rates are trending upwards and vacancy is declining. So that really is a perfect storm, if you will, for landlords, for multifamily investors, because that's exactly what you want to hear. Now, my specialty and the areas we're going to cover today are both LA County and San Bernardino County. The rough border lines, if you will, are we service as far as the 710 freeway, as far west as the 710 freeway, as far north as the 210 freeway, as far south as the 91 freeway, and then as far east as the 215. So these are the various areas we're going to be discussing today, and we're going to walk through what is the average price per unit in your area. What is the cap rate? How much sales volume sold over the course of 2021? What are the rental rates of a studio, 1 bedroom, 2 bedroom, 3 bedroom? And then of course, we're going to talk about what can we expect to see throughout this year in terms of where will values end up. And I think you're going to be very excited about what the findings tell us. Now, if you happen to own outside the areas that I just outlined, but you still own multifamily in Southern California, then I would say contact our office and we can pull the same data for you. So for example, if you own in Orange County, you own in San Diego County, you own in Riverside County, we can pull this data to assist you. If you own much further than that, we're probably not the right source, to be honest, because again, that's outside our wheelhouse. We specialize in multifamily properties, 5 to 50 units in the geographic area that I've discussed. Now, the first corridor we're going to discuss is what we call the East LA corridor. Now, the East LA corridor is the data we're looking at is compiled of the zip codes 90022, 90023, and El Sereno. So what did we have in 2021? Well, you'll find that the average cap rate was 4.9%. Sales volume for the area was $48 million. Not very impressive, and we're going to touch on why that is. And the average price per unit, $185,000. Now, of all the areas we're going to discuss today, unfortunately, East LA is the only area that's actually on the decline in terms of property value. Well, why is that? East LA is in the unincorporated area of LA County. The unincorporated area of LA County is led by the Board of Supervisors there. And they decided about 2 years ago they should dream up their own version of rent control. And in that version of rent control with the pandemic, they also decided that there should be no rental increases. They also decided by the end of last year, the end of 2021, you should register your units and tell them all there is to know about your personal information. Who are your tenants? How much are they paying? And so forth. That has put a bad taste in investors' mouth. Even when rental increases come back, they are only allowing a 3% increase. So the obvious question is, why would you buy in this area unless you're getting a deal? Because if it's not a deal, then you could own in any surrounding city and raise your rents this last year, say, by 3 times the amount that they're allowing in East LA. Why do I say 3 times? Because if you own in most any city in Southern California, those cities are under the statewide rent control. And under statewide rent control, the guidelines are you can raise your rents by 5% base plus whatever the change in CPI is April over April of the previous year. So soon, we're recording this video here near the end of January 2022. Come here May of this year, we're going to find out, okay, well, what's the CPI that we'll be able to use for rental increases beginning in September of this year. So you could have raised your rents 8.6% in LA County. In unincorporated, actually it's 0 because they wouldn't allow rent increases. But if you could have, it only would have been 3%. Investors are saying, why would I take 3 when I can get 8.6? So you can see the challenge with that area. Okay, our next corridor is the 710-91 corridor. This is comprised of Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Paramount, and Southgate. Why do we lump the cities together the way we do? Because typically the price per unit, cap rate, are similar. Tenant demographic is similar. Rental rates are similar. So it's the right way to piece together the cities in order to have an understanding of how, if you're trying to get large portions of LA County broken down, how to do so. You want to use those similarities. Okay, the cap rate in this area on average is 5%. Now, have properties sold at lower cap rates? Yes. Have properties sold at higher cap rates? Yes. The average is 5%. Sales volume, 123 million. So you see that's 3 times the East LA corridor, and this is more on average of what you're likely to see, this type of sales volume, if not more. And the average price per unit, 180,000. Our next corridor here, Pasadena, much different than the first 2 corridors we just walked through. So in Pasadena, we're looking at Altadena, Pasadena, Sierra Madre, and South Pasadena. The average cap rate among those cities is 3.8%. Sales volume was 196 million last year, and the average price per unit, 316,000. Now, the West San Gabriel Valley. This is comprised of Alhambra, Arcadia, Hacienda Heights, Monterey Park, Rosemead, San Gabriel, and Temple City. Here, you'll find that the average cap rate last year was 3.5%, sales volume 81 million, and price per unit, the average was 325,000. Values, again, have not skipped a beat even throughout the pandemic. In the eastern San Gabriel Valley, Azusa, Baldwin Park, Covina, Duarte, El Monte, Glendora, Laverne, Monrovia, San Dimas, South El Monte, and West Covina. Your average cap rate is 4.2%. Sales volume last year was about 180 million, and the average price per unit, 262,000. Now, the 605 corridor is comprised of Bellflower, Downey, La Habra Heights, La Mirada, La Puente, Lakewood, Montebello, Norwalk, Pico Rivera, Santa Fe Springs, and Whittier. The average cap rate here over the course of 2021, 4.4%. Sales volume, 209 million. Price per unit, 274,000. Now, as I mentioned, we also work the Inland Empire, San Bernardino County, and my partner, Deepan Shah, is actually going to walk us through the data in those areas as he is the individual on our team that specializes in that area. Let's see what took place in the Inland Empire in 2021.
Hi everyone, my name is Deepan Shah from the Apartment Dealer, and as Chris mentioned, I specialize in the Inland Empire market of our regions. Now, we've seen some interesting transitions over the last few years with respect to the market here in the Inland Empire, starting with the amount of rental rate growth that has occurred, coupled with the raise in price per unit and the overall vacancy rate decline. Now, this has occurred based upon a few things. Number one, many tenants have been moving from coastal cities seeking more affordable housing here in the Inland Empire. Number two, blue chip companies like Tesla, Amazon, and many more have created their hubs here in the Inland Empire, creating more stable jobs and higher paying jobs. And lastly, a lack of construction of new units has really suppressed supply in these markets. So many tenants are fighting over these available units, which is increasing the price in the rental market. So now as we go over some of this data, keep in mind these three things that I mentioned because they will reflect in the numbers. So first, let's start off with the Inland Empire West. This consists of Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, and Upland. The cap rate was 4.1%. The sales volume was $55,300,000, and the price per unit average increased to $208,000. Now moving on to the Inland Empire East. This consists of Bloomington, Colton, Fontana, Rialto, and Riverside. The cap rate in these areas was an average of 5.5%. Sales volume was drastically lower in these areas at 6.7 million percent. Now this can be a number of things, but generally it means that the owners in the area are just transacting less. And the average price per unit in this area was $167,000.
Now, you may be asking yourself, well, it's helpful to have this information, but we need some point of reference. Say what's happened over the last 5 years, 10 years, what's been that trajectory when you're looking at cap rate and price per unit sales volume. That is something we do dive into, and it takes a much deeper dive, more time, and that's actually what we discuss. One of the items we discuss at our apartment owners' educational webinars, educational luncheons that we host for our clients and so forth, and for multifamily owners at large. If you own within the boundaries that I gave earlier in the video, if you own multifamily in those areas, then definitely you can be a part of those educational events, and we take a much deeper dive into the data and really take a look at, say, the last decade as we're walking through the numbers. Okay, now let's take a look at, well, what was the highest sale in each of the corridors? Because at least that gives us some sense of, well, what's the ceiling, if you will, or what was the most aggressive sale that we saw over the course of 2021. So let's take a look at East Los Angeles. And again, when we're saying highest sale, we're saying based upon price per unit, not total price of the property, because then we would only be looking at large, big buildings. We're talking about what was the highest price per unit in multifamily properties between 5 to 50 units. We have this property here in East Los Angeles sold for $326,000 per unit. That was in the city of El Sereno. It was a newer constructed property, but even so, that's a big number for El Sereno. That actually was a flip. The investor who owned it about a year or less. And so El Sereno doing just fine in terms of values. 710-91 corridor, we have the 6-unit property that sold for $345,000. Of all cities, in the city of Southgate. And the reason why I say that is because if you know this corridor, you might have thought, well, you're going to see the highest price come out of maybe Huntington Park or maybe Cudahy, where there's single-story houses on large lots, and so those a lot of the times fetch really big numbers. But 6 units in Southgate, $345,000 per unit, a very impressive sale. In Pasadena, the highest sale was $525,000 per unit in South Pasadena. So if you're going to look at that corridor, no surprise it took place in South Pasadena. Very coveted area. And it's just that, right? If you're buying in South Pasadena, paying this type of money, it's not because you're looking for cash flow. You're an individual that's looking for tax write-offs and appreciation over the long term, not day one, huge cash on cash returns. And every investor is different, right? Okay, West San Gabriel Valley. We had a 10-unit sell in the city of Monterey Park for $620,000 per unit. Now, it was a nice property, newer construction. And when I say newer construction, the bulk of multifamily properties here locally was built in the 40s, 50s, and 60s. So anytime you can get your hands on something built in the 70s, 80s, or 90s, that's considered newer construction because there's less of it. And less of those properties come on the market because there's less of them in terms of the total supply. So this investor thought enough to pay $620,000 per unit. East San Gabriel Valley. We have this 5-unit that actually sold on Monterey in Monrovia for $480,000 per unit. Now that's very uncharacteristic for Monrovia. I can speak personally to this because the last 2 years before 2021, I had sold the highest price per unit building, or I represented a client who owned a property in the city of Monrovia, and twice we had sold at the highest price per unit, nowhere near $480,000. Now this property sold off market. It was very nice. The previous owner, had went to great lengths in terms of the capital improvements. I mean, some of the finishing materials are what you would probably put in your own home, not in, say, an apartment building. Just a very nice property. And this investor thought enough to pay $480,000 per unit. In the 605 corridor, we have this 18-unit that sold in Whittier on Pickering for $483,000 per unit. Again, that's uncharacteristic for the 605 corridor, where maybe before, highest prices would have been, say, in the mid $300,000 per unit range. Here we are, $483,000. Now let's take a look at what were the highest sales when we look at the Inland Empire.
Now moving on to the highest sale in the Inland Empire West. It was actually 15 units in the city of Ontario at a sales price of $5,250,000. It was newer construction, or I should say considered newer construction, as it was built in the 1980s, townhouse style units, but nonetheless a price per unit of $350,000 in the Inland Empire. Something to say about that. Now we move on to the Inland Empire East. There was 7 units that sold here on Bennett Avenue in Fontana for a total sales price of $1,475,000, which equates to $211,000 per unit. Now, these units were single-story cottage-style units on a large lot, no shared walls between the tenants, which is why this property attained such a high price.
Okay, so what have we learned so far? Values in most areas are very strong, stable. When you look at those highest sales, we're talking about some big numbers. I'm sure to some of you are surprised that buildings are trading at those prices in those markets. And what did we learn before in one of our previous videos? That over the course of 2021, investors found safety and security in multifamily properties, so much so that 1/3 of all the money that was invested in commercial real estate in the entire nation over 2021, 1/3 of it was invested in multifamily properties, and hence supply and demand. So the more demand there is, obviously it's driven up prices, and also this next component, which is the rental rates. So when we take a look at the rental rates across the board, rents are on the upward trend. Let's start in the East Los Angeles area. Now you can pause this video in case I go too fast. I'm not going to give you every single rent. So pause it, find your area, and I think that'll be helpful for you. But let's take let's paint in broad strokes. Let's take an overview here. So if we're talking about East Los Angeles and East Los Angeles proper, right now you can look at obtaining about $1,100 for a studio, $1,500 for a 1-bedroom, $1,800 for a 2-bedroom, and $2,000 for a 3-bedroom. If we're talking about the 710-91 corridor, let's say in Maywood, $1,200 for a studio, $1,450 for a 1-bedroom, $1,700 for a 2-bedroom, $1,950 for a 3-bedroom. Now let's take a look at Huntington Park. $1,275 for a studio, $1,550 for a 1-bedroom, $1,800 for a 2-bedroom, and $2,100 for a 3-bedroom. And the other cities are going to be in between there. The average for the corridor, for that entire corridor, all the cities involved, is about $1,200 for a studio, $1,400 for a 1-bedroom, $1,680 for a 2-bedroom, and about $2,000 for a 3-bedroom. Pasadena. If we take a look at Pasadena proper, $1,500 for a studio, $1,900 for a 1-bedroom, $2,400 for a 2-bedroom, $2,800 for a 3-bedroom. If you take a look at South Pasadena, $1,575 for a studio, $2,100 for a one bedroom, $2,500 for a two bedroom, and $3,000 for a three bedroom. These rents are very impressive. I mean, I think about when I bought my first home, something like, I don't know, 12, 13 years ago. My mortgage was essentially what people are paying for a three bedroom apartment in some of these areas now, right? So things are on the upward trend. And you think about just that. As rents have increased, it gets more difficult for tenants to save their initial down payment to buy a home. Now you couple that with the fact that interest rates are going up this year. They've promised 3 times. I just read a report that given inflation and all the craziness in the markets, the Fed may be forced to actually increase the interest rates 4 times this year if they want to get a hold of things. And if that's the case, affordability of homes becomes more and more out of reach. That means it makes more individuals tenants. The more tenants there are, more demand. That'll drive up rents. Okay. Western San Gabriel Valley. If we take a look at, say, Alhambra, $1,400 for a studio, $1,800 for a one bedroom, $2,200 for a two bedroom, and $2,600 for a three bedroom. If you look at Temple City, $1,400 for a studio, $1,800 for a one bedroom, $2,200 for a two bedroom, and $2,850 for a three bedroom. So very high averages in this area. I mean, you're talking about $1,400 for a studio, $1,800 for ones, $2,200 for two bedrooms, $2,700 for three bedrooms. I mean, these are very aggressive rents, right? Good news for landlords. The Eastern San Gabriel Valley. So if we take a look at, say, West Covina, $1,195 for a studio, $1,695 for one bedrooms, $1,895 for two bedrooms, $2,200 for a three bedroom. Jump over to Baldwin Park, $1,195 for a studio, $1,450 for a one bedroom, $1,800 for a two bedroom, $2,200 for a three bedroom. The averages in the area are about $1,270 for a studio, $1,636 for a one bedroom, $1,900 for two bedroom, and $2,200 for a three bedroom. I mean, to give you some point of reference, when I first started in the multifamily industry selling multifamily properties, the East San Gabriel Valley was the initial corridor that I worked. I only worked that corridor initially as a newbie. And if you would have said, well, what were studio rents at that time? Studio rents at that time were maybe $700 in this corridor, one bedrooms $900, two bedrooms maybe $1,250, $1,300, three bedrooms maybe $1,600, $1,700. So we've come, and that's starting in 2007. So we've come a long ways since those days. All right, 605 corridor. Take a look at, say, Pico Rivera, $1,400 for a studio, $1,625 for a one bedroom, $1,925 for a two bedroom, $2,100 for a three bedroom. Then you take an area like Lakewood, $1,275 for studios, $1,425 for one bedrooms, $1,850 for two bedrooms, $2,100 for three bedrooms. So we have our average for the corridor, $1,284 for studios, $1,487 for ones, $1,844 for twos, nearly $2,100 for three bedrooms. And again, as a reminder, this data came from 3 sources. Zillow, so essentially what apartments that are on the open market today, what are landlords asking? Rent-O-Meter, which takes real data from in terms of what rental rates are being achieved. And then CoStar, which also brings all the data together, not only of the apartments on the open market for rent. CoStar owns apartments.com, so they have all that data. And then as well as buildings that have sold, what were the rent rolls on those buildings that sold? So they have a lot of data. Now let's take a look at where the rental rates are in the Inland Empire. And spoiler alert, if you've watched earlier videos, the Inland Empire saw the largest growth of rental rates over the course of 2021. Let's dig into those numbers now.
As we move over to the rents in the Inland Empire West region, when I first started in this business 7 years ago, I never would have thought that rents would have grown this drastically at such a fast pace. If we take a look at the studios in Pomona at $1,295, studio in Rancho Cucamonga is $1,350, a one bedroom in Ontario $1,525, a one bedroom in Upland $1,550. Now the average of the one bedrooms across this region is at $1,552. The average of the two bedrooms across this region is at $1,831. And the average of a three bedroom is $2,287. And as we move into the Inland Empire East, you'll see that the rental rates are not as aggressive, but studios here for an average of $1,216. One bedrooms in this area average of $1,344. 2 bedrooms, 1623, and finally 3 bedrooms at 2136.
Now we're going to take a look at how CoStar chunks down their corridors and what are they forecasting for 2022. Now to understand their corridors, you'll see the map here and how they've chunked together their cities a little bit different. Call their corridors by different titles, but we're covering all the same area. So now let's talk about the Pasadena submarket. In 2021, what they found was the average vacancy rate was 3.2%. Rental rates grew by 7.3%, and the market cap rate was 3.9. What are they forecasting for 2022? They are forecasting that vacancy will actually decline further to 2.3%. Annual rent growth won't be as high as it was last year, but it's still going to be at a really good gain of 5.9%. And your cap rate is going to stay the same at 3.9%. Now, here's something to keep in mind, okay? Because what does that tell us about the projection of property values? If the cap rate stays the same as it was last year, but the rental rates grow by X amount, then that means the property value is going to grow by slightly more than the annual rental growth rate. Well, why is that? Because when you look at cap rate is dependent upon net income. And we have a video already recorded that you can find that we talk about how do you determine cap rate. But the bottom line is as we're comparing cap rate to growth in rent is based upon gross rents. And so very easily, here in this corridor, we're looking at property values to grow by at least 6%, if not more. Okay, San Gabriel Valley multifamily market. In 2021, the vacancy rate was 1.7%. We're looking at that in 2022 to grow just slightly by a hair of 1.8%. I'm going to argue it's going to fill and be about the same. Annual rent growth over the course of 2021 was 7.5%. Really good rent growth in San Gabriel Valley. This coming year, or this year, 2022, we're projected to increase rents by 6.3%. And cap rates in 2021, on average, they found the way they've cut up the map was 4%. Cap rates for 2022 are 4%. So what do we know? Property values will grow by at least 6.3% or more this year. Is anyone getting excited if you own in these corridors? I hope you are. Okay, the Southeast Los Angeles submarket. Again, they cut up their map a little bit differently, but you can see what cities are all included. 2021 vacancy rate, 1.9%. That's going to decline to 1.4% this year. Annual rent growth last year was 3.6%, and they're projected to see a growth in the submarket to 6.5%, double of what it was last year. So if you own in this area, you have to be excited about that. And then your cap rate, 4.4% in 2021, and they're projecting 4.4% in 2022. So property values are going up. In South Los Angeles. Now, when we hear South Los Angeles, for most of us, we might think of like South LA. That's not how they're not using the term that way. Focus on the map so you know what cities are included. In 2021, the vacancy rate, 1.6%. 2022 will stay about the same. 3% is an average that typically is used. So when you're at 3% or less, that is in a landlord's favor. Annual rent growth over the course of 2021, they saw an average of 5.4%. They're forecasting 6.3% this year. So I just want to point this out again, that last year we saw historic gains in rental rates. Across the nation, it was 11%. That's the highest number ever recorded for rental growth. What's the second highest year? It's actually going to be this year. That's what's projected, is that 2022 will be the second highest year ever recorded for rental growth. You're starting to get that firm footing we're looking for. You're starting to feel secure about being involved in the market this year. I hope so. And cap rate, 4.2 was the average cap rate in this corridor in 2021. And we're looking at the same cap rate of 4.2 this year, except rents will grow by 6.3%. So values are going up. Now let's take a look at what's the forecast for 2022 in the Inland Empire.
Now, taking a step back for the general overview of both of these submarkets. As we see here in the Greater Ontario area, which is the Inland Empire West, last year we saw a vacancy rate of 1.9%. This is extremely low for the area. As we look forward into 2022, CoStar is forecasting a slight uptick of 2.9%. Now, as we move on to annual rent growth, we can see that in 2021, Inland Empire West experienced a huge outburst of 17.3% year-over-year rental growth. And again, this is coupled by the items that I mentioned before of growth spurred from individuals or tenants looking to move away from coastal cities to more affordable housing, the blue chip companies now creating their hubs here, and a lack of new inventory in the market. CoStar over 2022 expects annual rent growth to subside to 6.9%, which still is drastically higher than many of the other years in the past. And finally, the market cap rate will stay the same at 4%. And lastly, the San Bernardino multifamily market, which consists of the Eastern Inland Empire. Vacancy rate here, again, last year was 1.8%, and CoStar expects this to increase slightly to 2.2%. Now, one of the things that you'll notice in this side of the market is that rental rate growth was not as high as the Inland Empire West. In the Inland Empire East, rents grew 10.6%. Obviously not keeping pace with Inland Empire West, but in the next year, as a forecast, CoStar sees rents to grow by 7.7%.
So I realize like you may be feeling it should be different, that this sounds too rosy of a picture. This sounds too optimistic. These are the facts. The facts I gave you on values, rental rates, cap rates for last year, those are real sales that took place. That's real data. The projections that we're looking at here are from CoStar Group, which have all the analytics in real time. And again, they do not have an opinion about the market. They simply share the data. The reason why we've taken a painstaking effort this month in January to simply take all our video time to share this information with you is because I understand. My team talks probably with at least 100 multifamily investors like you a week, at least. Personally, I probably talk to 30 or 40. And I understand the general emotion, anxiety in the marketplace. I'm saying, okay, and again, understandable. I'm not being judgmental of anyone. What I'm saying is we have to set that aside because we may make the wrong decisions based upon emotion. Let's rely on math. What does the math tell us? What do we know to be true about the market? And as landlords, what should we be concerned about? What impacts multifamily property values? What impacts multifamily investors? It's the income, it's your appreciation growth, it's your tax shelter, and it's interest rates. Everything as of the recording of this video is in your favor. I hope you feel good about the product you own. I hope you feel good as you outline your strategy for this year. I hope this information was helpful. Should you have any questions and you own in the corridors that we service, please feel free to reach out to my office. We're more than able to help you with the data and information that will help you to determine what is best given your goals. Chris German from the Apartment Dealer, and as always, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.